Good evening, good evening, good evening. It is Thursday. Text T Tish. Sorry, guys, I was looking at my phone. It is Thursday. Happy Thursday. It is Text T Thursday with Tish. Um, I'm waiting for some people to come on in. Come on in. I am running a little behind. I am under the weather, so I won't take too much of you all's time tonight. Tonight I will be discussing high income earners. Where them ballers at? Where them ballers at? Come on in. It is Tax Tea Thursday with Tish. Again, like I said, we will be discussing high income earners. And I do have some goodies for you all tonight when it comes to this topic. So if you are a baller, shot caller, then this live is for you. Welcome, welcome, welcome. Tax Tea Thursday with Tish. Again, if you are an high income earner, again, this live would be for you. If you know someone who is an high income earner, go ahead and like and share with them as well. Again, if you are a baller, this live is for you. And if you're not a baller yet, you can still tune in and still get the tea and learn more about ways to save your money for the future. As you all can see, I have on some new merch. This is my fleece that I just purchased with the LC logo here. So we're gonna go ahead and get started. Like I said before, we are talking about high income earners. So if you all are a high income earner, you probably feel like the IRS is, I would say, looking at you the most, or interested more in your paycheck. And you are absolutely right. The tax system is built for people that make more so they can take more, right? But today I'm going to show you how to keep, your money legally. And also, again, it's your money. So we want to be able to help you keep your hard earned money, reduce your, excuse me, reduce your taxable income. We want to help you, of course, avoid IRS audits. If you're making 6 or 7 figures and want to stop overpaying the taxes, stick around. This is for you. Go ahead and share. Thank you all for joining. Again, we will be talking about high income earners, those ballers. Again, for those who do not know me, I am Letitia Wilson. I am your financial advisor, specializing in helping high income individuals and business owners like yourself maximize your wealth and minimize your tax liability. I do work with professionals, real estate investors, attorneys, other type of business owners as well, and those who, owe the IRS, to develop legal tax strategies to help them reduce the amount that they owe. And of course, if you don't owe, then we want to keep it that way, right? If you are ready to take control of your taxes, drop some fire in the chat for me. Drop it, drop it, drop it. Again, I'm not going to keep you all long. I sound kind of stuffy, so if you hear me kind of, sneezing and trying to clear my throat throughout this live, I am under the weather. By the end of this live, you'll be able to walk away with some tax saving strategies to help you implement right now, things that you can do right now. And if you want to dive deeper into a tax strategy, you can book a session with me at www.lcfinancialsolutions.com, or you can go to my personal page, Letitia Wilson, and click the link in the bio, or my business page at LC Financial Solutions and click the link as well. Remember, guys, in this video, I'm going to tell you what to do, right? So the what to do is always free, but how to do it is actually what you pay for. So even though I will go over different strategies, not every strategy will be the same for one person. This is why we do recommend that you book a call with your tax strategist to see how you can save money based off the earnings that you make, right? So our segment one is going to talk about how the tax system is designed to take more from high earners. So of course, the more you earn, the more that they take, right? So the U.S. tax system is progressive, meaning again, the more you earn, the more that they take in a percentage, right, off your gross income. So if you're making $200,000, you're most likely going to pay, 32 to 37% within that tax bracket. That's the tax bracket you will fall into. Plus, of course, if you got self-employment taxes and if you are business owners and things like that. Thank you all for joining. We are talking about high income earners, the ballers, shot callers. And if you are not an high income earner yet, still stay tuned because you can use these tax strategies to help lower your tax liability, right? Um, so an example of, I would say, two taxpayers, right? So you can have someone who's making around $50,000 a year that can pay 10 to 12% in tax, or you can be someone making $500,000 a year, right? That could be paying up to 37% on a portion of their income. So if you are making $5,000 and you don't have a tax strategist, please book a call with us at lcfinancialsolutions.com, because I'm sure if you don't have a tax strategist, then I'm pretty sure you're probably overpaying in taxes. So, with you overpaying in taxes, this means, of course, high earners contribute to the majority of the tax revenue, and the IRS loves that, right? They want you to not have a tax strategist, right? They want you to pay all this money in taxes, and you get the refund, right, at the new year, right? But here's the secret. So wealthy people don't necessarily pay these high taxes because of certain tax codes that are in their favor. This is why it is very important for you to obtain a tax strategist when you are becoming a high income earner or having that business, because you want to make sure that you are taking the corrective action to make sure that your tax liability is as low as possible, right? So one tech strategy that you can use, which I've talked about previously on a live, is leveraging business deductions, right? So if you're a business owner or a 1099 earner, meaning that you have gig work as far as like Uber, DoorDash, and things like that, because those gig workers can make a lot of money just like a W-2 employee, right? So with that, tax codes will be your best friend when it comes to leveraging those business deductions, because with business deductions, you can legally write off home office expenses, marketing and advertising, business travels and meals. You can even hire your spouse or your children for that fact. And with the children, you can have up to, I believe, 14,000 tax free per child. Now, don't quote me on the 14,000. It is 2025, so those fees could have went up, but I am sticking to 2024 numbers. Because I am testing for an IRS test and they tested me on 2024 numbers. So that's what I'm going to be talking about in this live tonight, right? I got to stay with my test that I'm testing for. And then you can also contribute to retirement. I always talk about that. I think I've been talking about retirement almost on every live that I've done so far. If you are a business owner and you don't have any W-2 income, you want to make sure that you invest into a 401k. Oh, excuse me, or some type of retirement plan. If you're not sure what type of retirement plan that you would want to invest in, go ahead and book a call with LC Financial Solutions, and we can get those strategies together for you to help you save on the back end, right? So, a second strategy that you can implement as an high income earner is taking advantage of the real estate tax advantages that are out there. So, real estate investors do have some of the best tax benefits through depreciation and cost segregation, which can significantly reduce your taxable income. If you are one of those high income earners where you make $500,000, depending on the type of real estate investment, you could probably only pay taxes on $200,000 of it. Again, when it comes to real estate and tax advantages for real estate, it looks different for everyone. Not one strategy works for everyone. So again, we do recommend that you go ahead and book a call so we can figure out the proper tax strategies for you to help, again, maximize that wealth and minimize that tax liability. Another strategy that you can use is to max out your tax advantage accounts. So you don't want to leave money on the table, right? You want to fund that 401k up to almost $23,000. And then, of course, if you're 30, I'm sorry, not 30. If you're 50 plus, it's 30,000 plus. Again, these are 2024 numbers, and typically these numbers do rise every year, right, due to inflation. So each year it increases over time. If you have a high yield savings account, with your high deductible plan through your employer, you definitely want to go ahead and invest in that. You can invest pre-tax dollars and after-tax dollars as well. I've talked about HSA a lot of times as well. I love HSA. So again, if you're a high income earner, or someone who may be not necessarily making six figures, but you make a high five figures, and you want to be able to lower that tax liability, because I did have a client who didn't make six figures but made a high five figures, but also did not have any children. So typically, when you do have children, those dependents can help, again, lower that tax liability and increase their refund. But in my client case, they did not have any dependents. So with them not having any dependents, they end up owing. So we did come up with a few tax strategies for them to implement for this year. So next year they should not owe at all, as long as they follow the strategies, right? Because I can tell you what to do, but you actually have to implement it throughout the year in order for it to work. So again, HSA, a health savings account, is definitely one way to go ahead and lower that tax liability. You can also do a Roth IRA or a backdoor Roth, which is basically taking the money in your traditional account if you made too much. And then you can go ahead and transfer it over to a Roth IRA. I'm not going to get too in depth because I do feel like that's a segment within itself. But you can take the money out of the traditional retirement plan that you have and go ahead and transfer it over to a Roth so it can grow tax free. Another implement or strategy that you can use to lower your tax liability, again, implementing advanced tax planning strategies. So as far as like a trust, um, even an S corp. And I say S corp because I feel like a lot of people talk about, oh, make your business an S corp, make your business an S corp, but it is so much more to an S corp than just selecting that because you're not double taxed, right? You want to be able to make sure that you are making money as a net profit to take home, right? Because the money that if you are a business owner, so let's start there. If you are a business owner and your business grows $100,000, you're not necessarily taking home the $100,000, right? Well, I hope not, because you want to invest into your business. So making a gross income of $100,000 and actually making a net profit of $100,000 is two different things, right? And even taking home $100,000, right? Because you can make more than $100,000 in your business, and then your net income could still be more than $100,000, but are you taking home $100,000? So those are three different $100,000, right? So with that, you want to make sure that you are using those proper strategies, again, to minimize the tax liability. If you are making over $250,000 a year, you definitely need an advanced strategy. Some key moves with the strategies include, again, switching your LLC to an S corp, and with the S corp, I would suggest that if your business is if you are making $40,000 plus in your business on average for 3 years, so not your business making 40,000, but you can take home $40,000 a year, on an average of 3 years. So in the last 3 years, if your business, not your business, if you have made $40,000 a year from your business, then I would suggest a S corp. But again, it's all depending on your tax situation and the scenario that you are in with your business. Again, you can use a trust to protect assets and reduce estate taxes as well, depending on how much money that you are making. But setting up a trust is definitely an advanced tax strategy that you would have to use, and I definitely recommend that you contact your financial strategist, even an attorney that deals with estates and trusts to help you with that, with those assets that you have. And then if you are in need of an estate attorney or a trust, probate, law, anything like that, I do partner with an estate attorney that can help you with your trust as well. So with LC Financial Solutions, we do have a book of business and a Rolodex of people who can help you if my team or myself isn't able to help you directly with something, especially like I said, when it comes to those estates and setting up those trusts, you typically want to deal with an attorney. And we do have an attorney on call. We actually have a couple attorneys. So if you need someone dealing with the state, if you got any criminal charges, as far as dealing with taxes, we have someone to help you with that as well. Another strategy that you can use to reduce your taxable income, again, is making sure that you are having some tax efficiency investing. Again, if you are a high income earner and you just say, you know what, I make a lot of money, but I don't necessarily want a business. There are ways to still reduce your tax liability if you are a high income earner that just has a W 2 and you are not interested in setting up a business, right? So you can invest in municipal bonds, which is interest earned, is typically tax free at the federal level and sometimes at the state and local levels as well, just depending on what state that you are in. You can also invest into index fund and ETFs. These typically generate a lower capital gain than actively managing funds, but they do help reduce tax liability, right? Harvesting, which is basically taking a loss on any investments that took a loss to help offset your capital gains, right? Oh, excuse me. So again, if you are a high income earner, but you don't necessarily want to have a business, you can invest in municipal bonds, index funds as well. And it's a couple other strategies as well. I'm not going to give out too many tonight. I just want to kind of keep it surface level as of right now. So the key is structuring for a high income earner. So the key is structuring your portfolio, right, for long term tax efficiencies so you can keep more of your earnings instead of handing them off to the IRS, right? Another strategy that you can use as a high income earner and or business owner is maximizing your mortgage and real estate tax benefits. So even if you don't want to own rental properties, your primary residence can still be a powerful tax saving tool. You can use mortgage interest deductions. You can write that off to where you can deduct up to 750,000 of loan interest. Again, 2024 numbers typically they do go up throughout the year. You even have property tax deductions where you can deduct up to $10,000 in state and local taxes as well. Even if you have a home equity loan or a HELOC, the interest from those is deductible for home improvements. You can even do for home efficiency, like if you have, I can't even think right now. I'm like I said, I'm sick, so forgive me. If you have like the greenhouse on your house, I can't think of what it is, but there are other tax savings that you can have when it comes to your home. Like I said, when it comes to savings, so property tax deductions, you got your SALT, which is state and local tax, which that's what SALT stands for. Again, up to $10,000, you can write that off, and then a mortgage interest deduction as well. If you are a high earning income earner, whether you are just a W 2 worker or a business owner, investing in real estate, like I said, is good. Even if you just own your home, you can have significant tax breaks to help you, again, lower your tax liability and build that wealth. And like I mentioned before, for high income earners, whether you're just a W 2 earner or a business owner, investing in that health savings account, right? Yes, Deja. Yeah, that's all cap. $10,000 of write off, right? I need all 10,000 each year, right? I need all 10,000. And again, like I said, they contributing to your health savings account. That is like a triple tax benefit, right? So if you have a high deductible plan, through your employer. A health savings account is one of the best tax saving tools, in my opinion. You got the tax deductible contribution, which again lowers your tax income. You have the tax free growth, so your money grows tax free inside of the account, and it's tax free withdrawal. So with the HSA, you can use the tax free funds for qualified medical expenses, and after a certain age, I believe after the age of 65, you can withdraw from your health savings account for any purchase, not just medical. So, of course, if you do have the health savings account, it's basically it's like a debit card. So they send you like a debit card. You can set up your PIN number and things like that, and you can use that account for all of your medical needs. So if you have a copay at the doctor, if you have to pay to get a cavity filled, you want to pay for the flu shot, those things like that, you can use your HSA. There are websites that you can go on to that's specifically for HSA. I want to say hsaeligible.com, but don't quote me, Google it. And it's a website that literally has everything that you can purchase for HSA. Typically, other big name companies, you can go on their website as well, and you can filter out their products for HSA, FSA eligible products, and you can get a lot of things that people really don't realize they can get. And then you can also withdraw the money. So just like your car breakdown, or maybe I don't know, your car breakdown. Let's just use it as an example, right? You can take money from your HSA and use that money to get your car fixed, but it is a penalty for taking that out because you're not using that for medical expenses. But I mean, it is there if needed, right? So again, for me, health savings account is a triple tax benefit. Like I said, is tax deductible contribution. Again, it lowers your tax liability. You can use your pre-tax dollars, right, from your employer, so you can already have money coming out, and then you can also use after-tax dollars as well to contribute to that which can get you a credit on your tax return. And then, like I said, if you're 65 or plus, you can take out a withdrawal for anything. It doesn't have to be medical. So just imagine if you had that HSA, right, and you contributing to it every year, and the money rolls over. So if you're contributing to it every year, and then by the time you turn 65, it's like, wow, okay, I got this money in my HSA. Guess what you can do, right? You can take it out. That could be, again, part of your retirement. And it's tax free because you're over 65. So now you can use it for whatever you please, which I feel is definitely one of the greatest tax loops. And for 2024 HSA, the contribution limit, if you're a single, is $4,150. And for a family, you can do $8,300. And if you're over the age of 55, you got a catch up of $1,000. So they'll let you add an additional $1,000 if you're over the age of 55. Again, these are 2024 tax numbers. So for 2025, they definitely should increase. Again, even if you don't use the money now, again, your HSA is acts as a tax-free retirement health fund. So it makes it a great strategy for high income earners, because again, if you are a high income earner and just say you're single with no dependents, hey, you know that you can contribute up to $4,000. And what's that's going to do? Lower that tax liability, or lower your taxable income, which at the end lowers that tax liability, right? So you want to be able to use that. And then, like I said, even if you don't use it, HSA is it rolls over, so it is yours. Even if you was to leave your employer, that money comes with you. So there are things that you want to avoid, so you can avoid IRS red flags that could trigger an audit, right? So there are plenty of tax code, plenty of loopholes, but you want to make sure that you can avoid an audit. So the red flag number one is large deductions, right? So you don't want to just go ahead and just write off all of those deductions every year, right? You want to be strategic when you are writing off your deductions. So when you are deducting things, the IRS expects consistency, right? So if you are just suddenly writing off like $100,000 in business expenses, but you only made $150,000, that's kind of like a red flag, right? So that's why we always say keep your receipts. Well, not we, I, LC say always keep your receipts, right? Because that is one of the things that I always tell the client. Let's get those receipts because if you really don't have receipts, I really just don't want to document it just in case of an audit. We want to make sure that we have everything in hand. I work with a tax attorney and we do a lot of audits, and I know from experience from doing that they always want those receipts, right? So it's one thing to have a bank statement, but if you don't have those receipts, sometimes they will disallow it. So if you wrote off $100,000 in expenses, right? And you say, "Oh yeah, I made 150,000, but I had 100,000 in expenses," and they say, "Okay, let's see the receipts." And you can't pull the receipts. Guess what? They're gonna disallow that $100,000 or whatever amount that you can't provide a receipt for, and then add it back into your taxable income. Now you have a higher tax liability. And if it's so high, sometimes they can say it's criminal, right? Because you again, the IRS want to see consistency. So it's possible to have written off $100,000 in business expenses, but you want to have those receipts to back it up. And then again, if you are audited, um, don't just automatically panic because as long as you have everything you need, you should be okay, right? The only people that panic during an audit is the people who don't have all their, ooh, excuse me, it's the people who don't have all their documentation. The second red flag is misclassifying personal and business expenses. Mixing personal and business expenses is a major mistake. You want to make sure that you keep those banks separately. And if you're unsure of how to do that, contact your tax professional. This is one thing I feel like in the business of entrepreneurs who are not making over $100,000 or who are just starting out, they don't have that business bank account, right? So when you don't have that business bank account and you're commingling your funds, it's almost a little harder. Well, not almost, it is harder to separate what is business and what is personal. But if you have a business account and all of the income and expenses are flowing through there, it's easier to handle and easier to manage, especially when it comes to bookkeeping. Because what I've noticed in being in the financial space for quite some time now, that people typically don't necessarily have a bookkeeper one, and then they don't have bookkeeping software. So when you don't have a bookkeeper or don't have bookkeeping software, a lot of times people will like to wait until tax season like it is now to say, okay, here's my bank statements, right? But going through 12 months of bank statements is not tax preparation, that is bookkeeping. So that is something that people have to understand as well. If you want me to go through 12 months of bank statements, which is crazy work, but going through 12 months of bank statements is not tax preparation, that is bookkeeping. So that is an additional fee and it's much more expensive. Or I wouldn't even say much more expensive, but that number is going to be higher because technically you should have had a bookkeeper that was helping you keep track and reconcile your books either monthly or quarterly just based off the income that you receive. So you want to make sure again that you are not misclassifying personal and business expenses because of course those are two different things and you don't want those commingled again because it can cause an audit and you definitely don't want your audit to go criminal. A third red flag when it comes to avoiding an IRS trigger is earning over $200,000 in a year without tax planning. The IRS audits high earners more often, but that's what they say, right? They they audit high earners more often. If you're making six figures and you don't have a tax strategy, you are leaving yourself open for scrutiny. You want to make sure that you have a tax strategist. Honestly, I feel like if you make over more than 50 to $60,000 and you don't have kids, you need some tax strategies because there are ways that we can help you again lower that tax liability. That is what we are here for. Again, earning as much money, you want to just make sure when it comes to avoiding those red flags or triggers, I should say, from the IRS, you want to make sure again that you aren't taking extremely large deductions. And if you are, you want to stay consistent with that, right? You don't want to have one year where you took $100,000 deduction and then next year the business that you have is not even a business no more. And then your third year, you come back and say, oh, well, now I got a business again and I want to take $75,000 in deduction, right? So they're probably going to audit all three of those years. And technically, you're supposed to keep your information for 3 years. Um, but if it's fraud, the IRS basically can go back the entire time, well, past 3 years, right? So you want to make sure that, of course, you're not completing any fraud. You do have those documentations. That's why LC Financial Solutions is big on document, because if we do have those documents ahead of time, right, and just say the IRS put their hand in the cookie jar, pull your name, you audit it. And you're like, oh snap, I just got this letter. What do I do? First, you're going to send it to me. I'm going to handle it for you. And whatever the letter says, it's going to be like, oh, okay, well, they want to see your receipts. We already have that. Here it is, right? What's crazy is before I got in the tax industry, right, I actually had someone else file my taxes for me, and I end up being audited, and my tax preparer wouldn't ghost on me. That's what really got me into the field of being a tax strategist, because I remember that feeling of one being audited and like, okay, what does this look like? This is scary. And two, my tax professional went ghost on me, like, girl, where are you at? Like, was not picking up the phone. When she did pick up the phone, she wasn't trying to be helpful. And that just kind of left me in a place of me figuring this out on my own. And thankfully, with me being audited, I still had everything that I needed. It wasn't even nothing to panic over. So I don't even know why she ghosted me, right? But that's another topic for another day. Uh, but yeah, so as long as we have those, again, documents, we are great. And when I was audited before I was a tax professional, I did have all my documents, sent it off to the IRS, got my letter back. Hey, you're good. Thanks for sending over your documents. Sometimes I just want to check. Sometimes they really don't even be nothing. I just really want to be nosy and check. And to recap everything that we talked about and some key takeaways, excuse me. Um, so again, the IRS is structured to take more money from high earners, but you can legally reduce your taxable income by using business deductions wisely, leveraging real estate tax benefits, maximizing those tax advantages accounts, like I said, with the retirement plans. And you want to structure your business for tax efficiency and avoiding common red flags, which we just discussed. If you are tuned in, what is one tax strategy that you learned today that you will implement? Go ahead and drop it in the comments. And if you are just catching the end of this live, I think that every strategy everyone should implement watching this is HSA, Health Savings Account. Implement it today. If you are working, implement that high yield savings account. Well, actually, it's probably maybe too late if you are a W 2 earner, because I believe you have to do that during open enrollment. If you already don't have a health savings account, you have to wait until, I believe, the October, November for the open enrollment. But if you are a business owner, they may look different on your end. You will have to contact the person that you need to set up. Sorry, I'm looking out my window. You would have to contact the person that's already set up with maybe your health insurance. So you'll be able to contact them and see how to set up the health savings account. And another strategy that you could implement is investing into retirement. Again, every live that I've been on so far, I've talked about retirement. It is important to me that we focus on building wealth now so we can retire and relax, right? Nobody wants to be 65, 75, 85 going to work because they have to. They should want to go to work, right? So if you need some assistance with setting up a retirement account, go ahead and schedule a consultation at lcfinancialsolutions.com. Go ahead and reach out. We do have two types of appointments. Well, technically three. A phone appointment, which typically some clients do. I have Zoom. A lot of clients like to do the Zoom interviews. And then I also have in person. I am located here in Fairview Heights, Illinois. So if you're interested in meeting with me in person, we can definitely meet at the office. If you are wanting more flexibility, again, Zoom calls are great so we can still see each other face to face. Again, if you want a personalized tax strategy that can save you thousands of dollars, go ahead and book a session with me now. Sessions are free, so that we do have a 15-minute consultation that you all can book, and we can talk about different tax strategies to help you maximize your wealth and minimize your taxes, right? So you can keep more of the money that you have earned. That is the whole point. We want to help you keep all of your money. Again, thank you all for joining me tonight on Tax Tea Thursday with Tish. It has been a pleasure, and I'm going to hop off again. Thank you all for joining. I am under the weather, so I was really trying to stay dedicated to being here tonight. One of my goals actually for this year is to go live every Thursday. So as long as that I'm able to do that, I will. Again, thank you all for joining. If you all need to book a tax strategy call, get your taxes done, go ahead and book a call. lcfinancialsolutions.com. You can also text our 24-hour hotline, 630-278-3272 as well, and we'll be able to text you. And you can also give us a call as well if you want to talk on the phone. We are here. Again, thank you all for tuning in. It has been a pleasure, and you all have a great night. That is the end of Tax Tea Thursday with Tish. Soon, I'm going to have, some music in the background, my own specialized music, because I am on Facebook, so, they like to mute you if you're using music that you shouldn't be using. So stay tuned every Thursday. Like and share. If you're watching this from YouTube, comment, subscribe. And again, share with your friends, share with them ballers, because again, they are the ones who actually need these tax strategies, right? So thank you all for joining, and have a great night. Bye-bye.